Hey everyone, Marty Mazzora here. Good morning, August 28th, Wednesday, 2019. Going to keep your pre-market update pretty quick this morning because at least on this chart there's not a lot to report. Stuck in this same trading range or consolidation range, if you will. For a while there it looked like we had a good shot of breaking back out to the upside. Remember, originally I expected that we'd come up, test, and then lose to lower levels. Some developments, mostly rhetorical as it relates to trade. Kept some optimism in there. Lost all that optimism on Friday when we traded new rounds of tariffs with China. We were really going to barrel lower on Monday, virtually no doubt about it. Shorts were coming in big time and really expecting to have a good time on the downside. President tweeted early Monday morning from the G7 conference that China's been calling and they're desperate to get together. The market just rallied huge off of that. Turns out China says no, they didn't, and they're not the least bit eager. Now, you'd think that that would have just caused the market to pick up where it left off on Friday. But the fact that the president said that suggests a real will on the U.S. side to get back to the negotiating table. If China suddenly expressed the same will, I expect we will see a huge rally and maybe even break out at the top end of this. Now, just to repeat myself for the 100th time, until tariffs as a tool get rolled back, the ones that have been added the last year or so, and essentially go away going forward, I don't think we have any right or any business getting too bullish or too optimistic about the market going to new all-time highs in any kind of sustainable way. In fact, we are seeing concerns now in many, many places that maybe the next recession is almost upon us, and that's confirmed, not resoundingly, but it is beginning to get confirmed by our own proprietary macro index that I talk about weekly. So this action in here, the fact that this green candle is being sold off is not a good technical sign for the market. We were much lower in here this morning, and the market's been battling back a little bit. We're about 10 minutes before the open. So folks, we'll just see how this plays out. I'll just kind of leave that there. Right now, not a good look. Right now, I showed you some volume trends yesterday. You would expect that, I would say that odds have to favor a breakdown below. If it goes with some force, you're going to see some stop losses get hit. It's going to be somewhat precipitous to the downside. And then we should be looking for some real attempts via Twitter or other places to kind of catch this market on the way down and buoy it a bit. We have to ultimately ask ourselves, though, how long can that go on without something concrete, at least on the trade front? So we'll keep you posted there. I said yesterday there's a lot of other things, longer-term technical trend indicators that I wanted to share with you. Just finding the time to put that out has been a challenge of late. So I'm just going to give you one this morning just because I said I wanted to give you more, and I will. Just keep watching the blog. But here is the relationship between the bond market and the stock market. And this is something we need to pay very close attention to because it is telling about conditions for the market, conditions in the economy, and so on. This is a weekly chart. This is the S&P 500 in the top panel. This is the ratio between the S&P 500 and TLT, the long-term Treasury bond ETF. We have data back to 2002. So when this line goes down, that means the S&P is underperforming the bond market. Obviously, when it goes up, it's outperforming it. So leading into the Great Recession and the Great Bear Market, you can see that the ratio was rolling over even as stocks were mounting to new all-time highs. You can see it was happening right in here before the nearly 20% correction during the European debt crisis. And it was happening in here during the corrections of 2015 and 16, which you can pretty much call one, and that was about a 16% decline. And it was just beginning to roll over before the big nearly 20% correction in the latter 3 months of 2018. And you can see we continued to slope downward. One thing I want to point out today, and again, this is on the weekly chart, is in these instances where they just turned out to be corrections, notice that we did have a lower high in here, even past it, and that would be concerning. But notice the bottom was coming up. We ended up with a higher low. Same thing here after after the market bottom in 2016. We had a higher low on the ratio line. Notice here, though, after the big decline in 2018, notice we are now mounting a lower low on the SPX TLT ratio line. That's not a good sign. That looks more like the 2008 bear market than it does the corrections that we came out of back in here. Again, this doesn't mean anything conclusively. It just says that as every day goes by, we see greater and greater risk that this could turn into something ugly, sooner than later. And of course, we're watching this all very closely. You want to look at the weekly charts, but you also want to look at the monthly charts because there tends to be, fewer false signals in these things when you go further out. So just again, a little simpler here. We had that nearly 20% correction again, European debt crisis, higher low, 2015 correction, higher low, 2018 correction, lower low, bear market, lower low. Things to be concerned about. There's much more of this that I can point to, and there's still some positive things out there that just aren't yet rolling over, and of course I'll point to those as well. But folks, I just want to give you a sense as to why the tone here has not been constructive. Thank you as always for watching and listening, and I'll talk to you again very soon. Bye-bye.